in this example, we're going to look at transactions for a retail business from the seller perspective. Again, we have to buy inventory and then we turn around and sell it to our customers. Key thing to always ask yourself is, who am I in that situation? Because that's really going to impact how you record these journal entries. So they told us that we sold merchandise for cash of $16,540 and the cost of goods sold was $9,920. And they indicate to you to record the sale first. So every time we make a sale, we have to record 2 journal entries. I'm first going to record what I'm charging my customer for that item, so that sales price, versus how much did it cost me to actually acquire that inventory. So they told us that they're paying cash, and they are giving us $16,540, and I have made a sale. So remember, your sales price goes with your sales revenue account. I'm charging my customer $16,540, and I'm charging them for merchandise that I purchased. So the cost of the goods, meaning the inventory that I just sold for $16,540, cost me $9,920 to purchase. So my cost of goods sold, my new expense account, increases by that $9,920. I had to spend $9,920 to buy the inventory that I just turned around and sold to my customers for $16,540. They then said that we sold merchandise on account for $10,430 and our cost of goods sold was $6,260. So accounts receivable, we're waiting to receive $10,430 sometime in the future. And we know accounts receivable is a holding place for cash. I'm waiting to receive that money, but I've already earned it. So we have to record our revenue in that sales account. And then we need our cost of goods sold. It cost us $6,260 to buy the inventory that we just sold to our customers for $10,430. In C, it says we sold merchandise to customers who used MasterCard and Visas of $107,820, and the cost of goods sold was $64,690. Anytime we make a sale and the customer uses any type of credit card, it is considered cash to our business. So when they swipe that MasterCard or that Visa, they're going to owe MasterCard or Visa, but MasterCard or Visa is paying our company immediately that cash. So that's a cash transaction for us. So we have our cash, and that's the sales price that we're charging our customer. And we know that our cost of goods sold, how much it cost us to buy that inventory, was at $64,690. So we're obviously always going to sell our product for more than what we paid for it in order to make a profit. Indeed says we sold merchandise to customers who used American Express cards. So again, no matter what type of credit card they're using, it is still considered a cash sale to us. And we always have to have that second entry of our cost of goods sold, in this case of that $20,650. And then it told us that we received an invoice from the clearinghouse for $5,130, representing a service fee that was paid for processing MasterCard, Visa, and American Express sales. So for us to actually accept credit cards, companies have to pay a processing fee. So some credit cards charge higher processing fees than others, such as American Express and Discover. That's why some companies don't accept those. But by us accepting credit cards and not just being a cash-only business, we're opening up the possibility of generating a lot more revenue for our business. So it's a cost of us doing business. So it's recorded as an expense. So it is an expense for us because it is part of us running and operating our business. And by accepting credit cards, it's hopefully increasing the amount of revenue that we generate and therefore hopefully generating a bigger net income.